Hi there. Welcome to the closing bell on the 30th of June. I'm recording this, and markets are continuing to rally. That S&P especially, it's really getting up there. But I think there is some resistance to come, and I want to show you why I'm a bit suspicious of the rally. There's a few reasons. I showed you the commitment of traders data last week. There's been an update on that, and I think quite an interesting update from last week about how different players are changing their positions in the market. So I want to outline that for you, and also just update you on the charts, show you what's going on, because we've got a situation now where the interest rates really are flying higher, and you'd usually be pretty wary for stocks in that situation, especially the tech stocks. So we have the 2-year rates in the US nearly back at highs from last year, but stocks seemingly ignoring it all and rallying further. So one of them's probably wrong, and I'm guessing it's probably going to be the stocks in the end. So I just want to outline a few of my reasonings why I don't think we need to be getting too excited about this rally right now. How long it goes on for, who knows? But it's getting up into nosebleed territory as far as my model's concerned. So I just wanted to, really drive home the point for you today about how things are looking. All right, so let's check out the commitment of traders data, see how it's looking. So here we have the S&P 500 data, and every week they show you how the different players are changing their positions. We have the dealers here, so that's your big banks. You really want to follow what they're doing. They often know what's going on, and their positioning can change quite rapidly. Asset managers, institutional, they're usually pretty long and are quite a large percentage of the long position. You can see there, they're 50% of the outstanding open position in the S&P, E-mini S&P futures, and that's often the case. The leveraged funds we have here, and their positioning can change rapidly. They're the big hedge funds, that sort of thing. Very important to watch what they're up to. Your other reportables, which I don't keep too much of an eye on, but their positioning as well, interesting to follow up on. And non-reportable positions, your small speculators, really. And we've got the positioning, which is what you want to watch, is the long side and the short side in each. You can see there. And we're looking at the change in position from one week to the next. So I want you to note a few of these key changes. The dealers last week on the rally, they were actually selling out of their long positions, and they were increasing their short positions. So that for me is quite interesting to note. Asset managers, not much to report there, nothing much changing for them. But it's the leveraged funds, and this is what I was showing you what was going on last week, saying I wonder what's going to happen to this huge short position. They had over 700,000 short last week, and look at what's happened this week. No, sorry, in the last week of what happened was the long position went down as the market was rallying, so they're getting out of longs and also covering shorts. 174,000 drop in that leverage fund short position, and that was what I was interested in seeing, what was driving the rally. So we got a few things jumping out at us there. Also, you can see across the board there was a lot of short covering. So we've got the non-reportables, 77,000 drop in shorts, other reportables, 55,000. So, a lot of that buying I can put down to short covering, and we've got the people who really know what's going on. They're getting out of longs and they're increasing their shorts. So that for me is one thing that jumps out at me on really what's going on across the market, which makes me think this rally in the E-mini may be a bit of hot air, and it's going up into very stiff resistance. And I have shown you this last week, but I think I really need to drive that home, that based on the way I look at things, this really is that area where everyone's getting bullish. And you've just got to be wary at this point. The top of the sell zone, so we've got this big wave up from 2020. We've had the retest of the point of control. It's now rallying up. It's been rallying for a long time, taking out all the people who have been getting short through here and selling out of positions. Now they're feeling like they're missing out, and they're buying into what should be pretty stiff selling pressure up in this zone in the big picture. So there's no sign yet of it turning down. So I've got to allow this S&P 500 to keep going if it needs to. If it does, all well and good. And really, now the month is over, I want to point out that we really do need to see quite a bit of selling pressure before it's going to look too terrible. So really a monthly sell pivot, let's say next month. We really need to see that take place with prices closing below the low of this month's trading and back below the 10-month exponential moving average. If that was to happen, the market would look really terrible because of this whole view of the big wave, failure to the point of control, up into the sell zone, and then rejection from there. That would then give me the target back to the point of control. If we got the selling pressure, creating a monthly sell pivot and a return to the long-term downtrend, that would be quite bearish, but it hasn't happened yet. But this is the sort of structure that I look out for that is, really interesting if it does take shape. And the way rates are flying higher, anything can break. These commercial property, especially, I've still got my eye on those, and they're still very weak in the US. Regional banks still very weak. If rates stay higher for longer, just gives a lot of time for some things start to come out of the woodwork as far as problems arising. So I just want you to be aware of that really big picture situation that this rally is now going up into pretty stiff resistance, and it may spike a bit further before the failure, but it really does need to take out that high for it to look super bullish. But also, I guess, if that long-term trend does turn up, then you've definitely got to be taking notice of that. But it is just one of those situations, I think, with the interest rates flying higher and stocks flying higher into really stiff resistance, and all of these players positioning themselves, getting out of longs, the people who are short and wrong having to buy back, so they're driving the price higher with the short covering. The people who really know what they're doing are getting out of longs and increasing their short position. So that just says to me, beware of getting too bullish at this point. So the ASX 200 has been just a nightmare to try to do any analysis on for such a long time. Look at this period here, just nothing going on for month after month after month. But now that we have this monthly sell pivot in place, really I need that negated before I can get too excited. And I'm very wary of the fact that we've had a big correction and then a rally up into what is the sell zone for me, and then this monthly sell pivot. So everything is in place for a leg lower as far as I'm concerned. And until we get, enough of a rally, let's say this month finishes, if next month we get a monthly buy pivot, then it's starting to look okay, isn't it? Long-term trend starting to shift. If the buying pressure can be there and it can break out above the all-time high, all of a sudden it looks like a very different market. But big picture, I'm just still very wary of the way it looks based on very long-term picture of this 07 high, the 2020 high, and it's just always wary of a market that's trying to struggle to break out and then fails to do so and can just return to the range for a while. And really, retail here getting hammered. Is the property market going to keep bouncing back with the mortgage cliff coming? Things aren't a situation where I'm saying buy. I'm saying just be wary. Even though we've really held in there quite well, everything's getting set up here that any nasty news, and especially back under 68.50 for us, is where it should start to catapult a bit more to the downside. But hasn't happened yet, and it's been months and months, hasn't it, of just going nowhere. But hopefully you're just feeling that you don't need to rush into stocks in a big way right now. There are a few interesting things out there that I'm looking at, different sectors. There's no doubt about that, but all up, yeah, still a pretty soggy market. But just finishing up on a few things, looking at the 2-year rates in the US, just to note, I mean, wow, what a move, huh? From 0 up to 5%. And, it had the banking problems in the US. We saw rates really come off, and that's been completely reversed now. And those, the Fed still staying hawkish, and those 2-year rates approaching 5% again. So we've got to ask ourselves, when are stocks going to sit up and take notice that is going on? I don't think it will be too much longer, especially if they do continue marching higher above 5% from here. So it's a pretty explosive situation, and the technicals certainly in that S&P and the things I showed you in that commitment of traders data certainly make me sit up and just be wary that, yeah, you don't want to be chasing it higher here, because if the music does stop or there's some bad news about, it can turn around and look pretty bad pretty quickly. So that's enough of putting the fear of God in you. I'm away next week, off to Singapore for a bit of a break, and so there won't be a closing bell next week, but I will be around the week after that. All right, cheers. I'll talk to you soon.